Before we move any further, I want you to do a little exercise. Stand up and warm up. I literally didn't mean that stand up and stretch yourself. Let us understand few basic concepts for you to understand the advancedly simple topic of investments. That is exciting, isn't it? So we'll look into investments and savings. What is interest? What is annual percentage rate? What are returns? What is inflation? And we'll also look at risk. I think this is going a little riskier now. Don't worry, I'm there with you. Hold on. Investment or saving? Investment or saving are two different things, but to simplify, we'll just assume that investment and savings are one and the same thing. Saving is basically what you are left over after you have spent. Once this saved fund is invested into various investment instruments or various investment avenues like fixed deposits, stocks, bonds, cryptocurrency, etc., that becomes your investment. A simple formula for that is whatever I earn minus my expenditure or spend which I do. That is my saving. Once I take this saving and put this saving to work for me, that becomes investment. It doesn't mean I pull out my saving and put it to a gambling sort of thing and that becomes my investment. No, that is absolutely not investment which I am talking about. That is not the context over here. Let's say your income is $10,000 and your expenditure is about $8,500. So you save close to $1,500. That is your saving. You, me, everyone has liking towards something. That is interest. No, that liking is not interest. Interest here is simply I pay you flat. Means I give you something in return for my money which you have given. Let me explain you by giving an example. Suppose you give me $100 and I agree to pay you flat 10%. That means for 1 year it comes to $10. So I'll get for 1 year. So I make $100 plus $10. That is my interest. Now again for second year I get 10%. So I get $10. So I get $20 for 2 years on an investment of $100. This is basically a simple interest. Means whatever principal I have, the principal will remain constant. The interest, the flat part, is not added to my investment, and that is why it is known as simple interest. So first year I would get $10, second year I would get $10 at the rate of 10%. Before I explain you the interest part in more detail, let me give you a famous quote by Albert Einstein. He said, "Compound interest is the eighth wonder of the world. He or she who understands it earns it. He or she who doesn't pays it." Now let us understand what exactly he meant by that. In the previous example we saw that I pay you flat, means I just give you a plain simple interest rate of 10% for the first year, also for the second year. So the total interest which I made in my previous example was just $20. Now in compound interest what happens? On the same $100 investment, I get 10% for first year. So 10 gets added to my principal. It becomes $110. Now this $110, that is interest plus this $10 extra which I got, gets me another 10% for the second year. So I would make $21 for the second year. So the principal or the final amount which I get over here is $121. In previous example, we just got 100 plus $20 extra, that is $120. Here we got $1 extra. This might not look that significant of $1. If you compare this with a longer period of say 10 years, 20 years, 30 years, 50 years, the compounding effect is much higher and much larger. So the always benefit from the power of compounding. Don't worry, I'll tell you how to make most out of this compound portion. That is, I pay you flat on flat. That is interest on interest. This brings us to a next very exciting concept. Annual percentage rate. Annual percentage rate, APR, what is it? Annual means yearly. Rate of interest is the flat, the rate of interest which we saw. Now instead of simple rate of interest, it gets compounded. Here the interest which is getting compounded. So annual percentage rate is nothing but the yearly rate of interest which gets compounded, annual rate of interest which we pay or which we earn on a particular investment. Now you would think, what is this animal known as return? Do I have to return home? Do I have to return to office? What is this return? Return is nothing but change in value or the price of an asset or investment over time. It is expressed in a simple form: percentage change of price of a investment or an asset over time. Let me give you a simple example. Suppose $100 you have invested, that became 121 considering the power of compounding. So the price changed from 100 to 121 in 2 years. That was a positive change. Now say I have invested the same $100 and the price change went downward and it became $80. That is negative return. So as an investor we always want positive things, not the negative things. So returns can be either expressed in positive terms or in negative terms. The more positive it is, it will give more positive smile. The more negative it is, it will give us a lot of stress and anxiety. Don't worry. That's why you need to understand these few concepts before we jump into investments. What is inflation? Inflation in its terms tries to tell you a story that I reduce the value of your money. Let's slap this inflation, isn't it? It reduces my value of money. So a $100 bill, it will reduce it to $80. It doesn't mean that my $100 bill will become $80. It will just mean that suppose I was purchasing a pen for $100. Say after 3 years, the same pen will cost me $150. So what it has done? It has reduced the value of my money. It doesn't mean loss. There was no loss which was there. It was just negative return on your value of money. That is loss. So inflation basically reduces the value of your money over time. In this module, we'll look into various types of investments, their risk profile and the risk associated with this investment, and how we can make investments. So we'll start with stock, equity and IPOs. Then we'll head towards mutual funds, then real estate and commodities like gold and silver, then fixed instrument, options, bonds, exchange traded funds. We would further move into understanding of insurance, wherein we'll understand life insurance and general insurance. Life insurance secures our life and general insurance is for other than life cover which is there. Then we'll look into small saving deposit schemes or small saving schemes. Then we'll touch upon derivatives, cryptocurrency, which is the most exciting part, but it is riskier, this investment. Then we have private equity and startups, and we'll also look at some other investment avenues which are there. So far we have looked into various goals, and now we'll look into how to achieve those goals via various investment avenues or investment asset class, and we'll also understand various market and how this asset class are bought and sold and the risk associated with it. Now before we begin, let me explain you the concept of equity and an IPO. Whenever a company is planning to raise funds, they will reach out to various investors. They will go and meet maybe 1,000, 2,000 or 5,000 investors directly and ask for money, and they will issue some sort of ownership that is initially known as initial public offer. Initial public offer is issued from the primary market because there is no stock exchange involved. Initial public offer basically means the first time offer which a company gives to an investor to invest and be with them for long term. Now this investment is between a company and an investor. Let's say after some time the individual wants to sell off his ownership, wants to liquidate his investment. He will go to a secondary market, that is stock exchange, and sell it to other investor. Hope till now it's clear. So primary market is the market wherein a company directly approaches an investor to invest. It could be a company, it could be a government, it could be anything. They can issue equity, they can issue bonds, and there are various other instruments or asset class that a company or an organization can issue. In a secondary market, this investment class or this investment asset or product get listed and it is traded between two investors, two or more investors. Now let us look at IPO. IPO is basically the first time offer, as we just saw. So how many offers do a company gets? And let me ask you, how many offers do you get? I'm sure you might be getting plenty, but here offer means how many investors are willing to invest into that company. So it's an initial stage of most of the companies wherein they are raising the funds. It is very important for you to read the offer document. So say IRCTC or say IBM is coming up with an IPO. All you need to do is search for the offer document. Offer document will give you what are the growth prospects, what are the business prospects, what is their company objective, what are the long-term objective, how much they are planning to raise, and what is their vision. All this is important to understand whether this IPO or initial public offer is good enough to invest or it isn't good enough to invest. For example, let's say a company's asset worth is 100 crores and a company is wanting to raise 500 crores. It doesn't look that attractive, right? Because from where they will pay the investor if they demand, right? So you have to keep all this in mind, and you need to first find out, is this IPO really worth it? Just don't fall in love at first sight with an IPO. You need to do your complete due diligence by referring to various offer documents, various scheme related risks, and then only take any investment decision. Now in equity you get an ownership of that company when it is traded in stock exchange. It could be a Bombay Stock Exchange or New York Stock Exchange, Dow Jones, or any other stock exchange of the world. Now the important question here is, how do you identify right stock? Whether a stock is a growth potential stock, or whether that stock would create value, or whether that stock would give me a regular income in form of dividend. You need to understand one thing. Companies make profit every year. Some companies invest those profit back to their company's growth, and in turn the value of the stock grows. So those are growth stocks. Value stocks are those stocks or those equity shares whose value is currently not that great. For example, let's say when McDonald's started, the value of McDonald's was not that great, but now they have such a large franchisee all across the world, so their value has increased. So an investor who would have invested into, let's assume that McDonald's was a value stock, he would have created a significant amount of wealth. But not all value stocks are good. You need to analyze and understand by reading the documents, by understanding the growth history. There are two thumb rules of investing. One, you need to understand what are the growth potential of this company. Number two, what are the risk factor which is associated with it. Now there are some companies who are very generous and they think that let's pay our investors something every year. So they pay you something in form of dividend. For example, out of 100 crores they have earned, they will distribute 20 crores in dividend. So that is how you get a regular dividend. Also, the stock is defined as per the market capitalization. Now you'll ask, what is market capitalization? Just remember, the bigger the company, the larger would be the market value or market capitalization. The smaller the company, the smaller would be the market value or market capitalization. For example, a small coffee shop would have a limited reach or limited amount of people whom it can reach, whereas a large value chain like Starbucks would have reached across the masses. Like that, in case of large stocks, it will have a large market capitalization. In case of small value stock or mid value stock, it will have a less market capitalization or market value. It doesn't mean that large company stock would give me large value growth or large value dividend. Not necessary, but they are more stable company. They are established in the market. Some of the names like IBM, Google, Infosys, and there are many more, are all large cap stocks. Then there are mid caps and small cap stocks. Mid caps and small cap stocks are riskier compared to large cap stocks. I'm not saying large cap stocks are risk free, but the risk reward return, if you can recall, the higher the risk appetite I have or the higher the risk I'm willing to take, higher would be the return. Small and mid cap stocks gives you higher returns over a longer period. Large cap stocks also gives you return over a longer period of time, but the return of mid and small cap stocks would be much higher if you invest into right company. Now that you have finally made your mind and you are firm on it that I want to invest in stock, what do you need to invest in stock? You need a brokerage account, you need a demat or a trading account. Demat and a trading account. Demat is basically where your stocks are held, like your bank holds money. In similar way, the company stocks are held in demat account. Then you need a phone or an internet connection to place orders or to buy and sell stocks. My request to y'all would be to buy a good quality stocks and hold it for a long term. Long term, I meant more than 10 years, 20 years, 40 years. If you can hold, it will definitely create value and it beats all asset class. Equity always beats all asset class. A 1 lakh rupee invested in stock market in 1979 would have grown to 3.9 crores rupees by now. That is the power of long-term investment in equity. An S&P 500 on an average gives about 10 to 11% return for an investor who has invested for more than 10 to 15 to 20 years. The historical returns states that the longer you stay invested, the better return or the better capital creation. Some question would be bothering you that regardless of so much of ups and downs, how could an investor create so much of wealth? It is possible only because an investor was patient and could hold the investment for such a long duration. Now, few things that you need to keep in mind before investing into stock market, that nothing is guaranteed. I repeat, nothing is guaranteed. Long-term investment, as we saw, always pays a handsome and a decent reward, and it always beats the volatility. You get a voting right. You have voting rights while you own the stock. And let me repeat, it beats all the investment product in long run. It literally beats. So in literal sense, it beats all investment in long term. A debt to equity ratio means how much the company has borrowed, how much is the capital contributed by the shareholders. So remember one thing, that companies where debt to equity ratio means total liabilities by total shareholders contribution, if it is more than 1, then that stock is considered to be risky. Don't invest into those stocks. I repeat, wherein a debt to equity ratio is greater than 1, don't invest on those stocks. Those stocks are very risky. Now, what is price to book value? Price to book value help you to understand whether this stock is undervalued or overvalued. Now, this undervalued and overvalued means what? Whether the stock price is not as per the price B, then it is known as undervalued, and if it is overpriced, then you consider that as an overpriced stock. For example, if you go and buy a pen, the real worth of that pen would be say $200 and it is available for sale at say $100. So it is undervalued. If the same pen is available for say $300, you would say that that pen is overvalued. Return on equity is basically the net income returned as a percentage of shareholders' equity. Remember the rule that always invest in a company where return on equity is greater than 20 for at least last 3 years. Consequently, the higher, the better, the lower, it is riskier. Current ratio is also important to understand if the company has sufficient liquidity. The thumb rule is that always invest in a company whose current ratio is greater than 1. This all ratios will help you to pick the right stock for your investment. You don't have to calculate most of these ratios, hence I am not showing you the calculation part. All is readily available on the internet for a particular stock. An important asset class is mutual fund. Now, what is mutual fund? Mutual fund is a pool of investors coming together to share and invest from a pool of money. Let me give you an example. Say there are 20,000 investors and they want to buy certain stocks of various companies. Not single investor could buy multiple stocks, correct? Hence the mutual fund was created, wherein a pool of investors pool their money into a fund, and that fund invests into various companies or various sectors depending on the fund type and depending upon the risk profile. What does an investor get? An investor gets something known as units. There you used to get, in equity market you used to get equity as share per unit. Here also you get unit. You get unit of various companies. You get units of various companies by investing into mutual funds. Now the value of that fund is known as net asset value or NAV. Let me show you an example. Here you can see this fund is a large cap fund which invests into large companies. It has a NAV. If you can look here, the NAV or net asset value is 85.96. So per unit price is 85.96. The risk is moderately high, and here it also shows what type of fund it is. We'll look into this in greater details. In mutual fund there is also something known as fees. There are various types of fees which are there. Entry, or in order to invest into mutual fund you need to pay an entry fee, that is known as entry load. And some mutual funds also has an exit load. For example, if you invest before a particular time period, say 3 years, they charge you an exit load, that is the exit penalty. Like you pay penalty in fixed deposit, same way they pay penalty. Here in mutual fund also nothing is guaranteed, but over the longer period of time it creates a larger value. It is a wonderful tool to create wealth over the longer duration. Now there are various types of mutual funds. There are focused blue chip funds which invest into large companies, the large companies which has a larger growth story and which are well established in the market. Then there are open-ended funds and closed-ended funds. As the name suggests, open-ended funds are funds wherein you could invest anytime throughout the year and you can exit anytime throughout the year, but that is not the strategy which you should adopt. You should invest into an open-ended fund and hold it for a longer period. A good open-ended mutual fund, and you could hold it for a longer period. There are closed-ended mutual funds. Closed-ended mutual funds are like IPOs. It is not exactly IPOs, but it is like an IPO wherein it has a subscription window wherein you can subscribe only between this date to this date, post which the subscription is closed, and you cannot redeem this closed-ended mutual funds because, as the name suggests, the fund is locked for a particular duration. Then we have something known as liquid funds. Liquid funds are like your liquid cash sitting in your account. It invests into highest rated government securities like GSEC and money market instruments. So just to explain you in simple terms, these are some of the most secured investment avenues: the government securities and money market instrument. Not all, but the highest rated one. These liquid funds invest into this sort of instrument. Then there is something known as balance or hybrid fund, which has a balance of say 50% equity and 50% debt, which gives you a slight buffer for risk. Now, then there are growth funds. In this growth fund invest into the profits into their business so that the company grows. As the company grows, the value grows. As the value grows, the net asset value grows. Then there is something known as monthly income fund. Monthly income fund, or MIPs, they are popularly known as MIPs. They give you a smaller dividend every month or an income on a recurring basis, but this income is not guaranteed. But they invest in such a manner that they will give you a smaller portion of income in a monthly form via monthly income fund. Then there are other funds like index funds. Which invest into stock exchange. They invest into directly into stock exchange. So as the stock exchange moves, the fund would also be moving in the same direction. If the stock market increases, that index fund would increase. If the stock market is declining, the index fund would decline. It is considered to be more riskier option. Then there is something also known as arbitrage fund. Arbitrage is basically a fund which gives you a tax efficient return. What I meant by tax efficient return is that they invest in such a manner that whatever returns you get in hand is tax efficient, means you get a better post tax return in your hand. It is basically in the range of 6 to 8%, but that too you have to hold it for a longer period. Then there are other set of mutual funds like tax saving mutual funds, which are popularly known as equity linked savings scheme, ELSS schemes. This gives you tax benefit up to the deduction applicable or allowed as per your country taxation law. Then there are sector specific funds. The sector specific fund, what I meant by this is, there would be power sector fund which would invest only into stocks or companies which are into power sector. There are infrastructure related funds which would invest only into roads, railways and building and construction sort of thing. There are banking related funds that would invest only into banking stocks. So these are sector specific mutual funds. Then there is also known as government securities funds or GSEC fund, which are specifically invest into government securities. And money market funds. These funds are considered to be more safer avenues of investment, and the returns are not that great, but it is a safe sort of instrument. You can park in your cash funds here. Whatever cash you have, you can park it into GSEC fund or liquid funds or money market funds. Index funds we already discussed. Small cap funds invest into companies which are in small category, means they are in just growing phase. They are not that big in size, but the growth potential is high. The smaller cap funds would have high volatility since it's in growing phase, but the return expectation one can have as a prudent investor is over 20 to 35 years. One could expect a decent return of about 15%. Good small cap funds. Then there is something known as gold exchange traded funds. Now what are exchange traded funds? Exchange traded funds are funds which are traded like stocks in a stock exchange. Now you would say, what is gold exchange traded funds? We all are very fond of gold, but nowadays keeping a physical gold has its own risk. There is a risk of someone stealing it, or it could be lost, or there are multiple risks associated with it. So instead of holding physical gold, you can hold gold in form of units, that is mutual fund units, which are traded in stock exchange. That is known as gold exchange traded funds. Then there are bond funds. We'll cover this while we cover the bond section. Then there are funds, mutual funds who invest into global stocks. Global funds would include international funds like investment into IBM or maybe in Amazon, any other top listed global funds. Now that we have a basic idea of various types of mutual funds, let us look at various options which are there in mutual funds. Some of the options are growth. These mutual funds invest into stocks, will give you a growth over a period of time. Then there are dividend yielding stocks. Dividend yielding stocks is basically the interest which you get, but that is not guaranteed by mutual fund company. They pay you a regular dividend. Then there are certain options like systematic withdrawal plan. It is basically a systematic redemption plan wherein you invest a X amount and you get certain amount every month or every quarter depending upon your requirement. This is basically suited for people who are in higher age bracket. Then there is something known as systematic transfer plan. Now what is systematic transfer plan? Systematic transfer plan systematically transfers every month from one asset class to another asset class. For example, it transfers from a debt mutual fund or liquid mutual fund to an equity oriented mutual fund. Why this is important? Because at times when the market is volatile, you might not know if equity would perform well or it is not a right time to invest. That is the major question which each of us have. So in that case, you can choose a systematic transfer plan wherein you can park in your money into liquid funds or a debt funds, and from there it would systematically transfer it into an equity fund. Then there is a powerful tool in your hand known as systematic investment plan. Systematic investment plan is the most powerful mutual fund option which is there. It systematically invests a sum decided by you monthly into a particular scheme. You can choose from the basket of schemes, but the longer the duration you hold, it gives you the power of compounding. You remember we discussed this compounding, the power of and the magic of compounding, how our money becomes double, triple and becomes 8 times. That is through power of compounding, and SIP helps you. An SIP of $250 per month in S&P 500 index fund for 40 years would have resulted into a wealth creation of about 19,80,563 dollars. That is good, right? Let me show you a live example. Now say you need X amount, so just drag this. Let's assume that you need about 1 crore rupees. Okay, then let's say you want to invest it for say 30 years. You're willing to invest for 30 years, and expected rate of return, let's say we are very conservative. Let's say expected rate of return is say 8%. Let's assume it is 8%. So this is the amount of SIP that you need to do to achieve your dream of 1 crore over 30 years. This is the power of compounding. This is the power of SIP. Now say you have some other option, like you want to invest whatever amount you could invest. Say for example you can invest say 20,000 per month, and let's say you can invest it for 30 years. Can you see the power of compounding at 8%? Now say if I select a mix of portfolio and mix of asset class, and that on an average gives me a return of say 12%. My return would be, or the wealth which would get created, is close to 7 crore rupees, which in dollar terms would be much higher. So let me go to xe.com and convert it into dollar terms. So let us copy the wealth which has got created in rupee terms, and let's convert it into any of the world currency. This is INR, that is Indian rupees. Let us convert it into US dollar. At today's exchange rate, you make 9,17,651.09 dollars. That is quite a decent sum. Likewise, you can get any other currency, say Great Britain pound, and you can see what is the amount of wealth that would get created. You can also put in the amount which you can invest, say in your currency. Say in Indian rupees, if I am investing 20,000, in pound I would have to invest say 210 pounds per month. This amount can vary from country to country. It's a very interesting tool. Just try using it and you will understand the power of compounding. Now let us understand some important benefits of investing into SIP. There are 12 powerful benefits of investing into SIP. That is, average out our cost. What it does, it average out our cost. For example, market would be up, sometimes it would be down. The net asset value keeps on fluctuating. So what it does, it will buy at various levels and it will average out my cost. It systematically builds wealth, that we already saw how it systematically builds wealth by using the power of compounding. It is the best long-term investment. It also gives me the choice of diversification. I can choose to invest into various funds. The choice of funds is with us. There is no need to time the market. You don't need to sit and worry, oh, what would happen if the market goes down? What would happen if the market is at peak? You don't need to do anything. You just need to select the tenure, select the funds, select various funds, start an SIP and leave it on a monthly basis. Suppose you miss out one or two SIPs that you should not miss out due to some financial emergency, you can always continue investing it, or you can park in that funds when you have the money with you. Also, SIP is very affordable. You can start with as small as $500 to $200 to 500 rupees to 5,000 rupees to any large amount. There is no upper capping on starting an SIP. It also gives you an convenience of investment. It will help you to achieve a lot of your financial goals just by using this powerful tool of SIP. It also takes into account the inflation adjusted return, that is known as indexation. For example, if you say that if I take indexation into account, that is inflation into account, I will have to pay certain less amount of tax on my investment, or if I ignore the part of indexation, that is inflation, I will have to pay more tax on it. It depends from country to country and investment schemes to schemes. Mostly it is very popular in case of mutual funds. Then remember the thumb rule that nothing is guaranteed in mutual funds. However, in long term it pays a decent value, that we just saw. So these are the 12 powerful benefits of investing into SIP. Start today, start now, and start now. Also, there are 6 things that as an investor you should avoid while doing an SIP. You should select an appropriate amount. It is not that you will select 500 rupees today, tomorrow you park in 50,000, day after tomorrow you park in 1,000. That is not a right way of investing into SIP. Decide an amount, decide a goal, and then invest into SIP. Please do not stop SIP suddenly, and please do not stop your SIP, because if you stop your SIP, you're sacrificing on your wealth creation goal and your goals would get hampered. Hence, please do not stop your SIP. That would be my humble submission to you all. If you forget paying SIP, if you miss out any installment, you can restart. That's not a problem. There is no perfect timing. If you wait and think, there is never a tomorrow which is going to come. Always choose the best mix of funds, basis the rating, basis the reputed rating, basis the research. Do your own research as well. Do not invest into SIP for shorter duration. I repeat, do not invest into SIP for a shorter duration. These are 6 common mistakes that you should avoid as an investor while investing into SIP. What is real estate? Real estate is also a type of investment class or an investment product. That the investment in property is known as real estate. Now, real estate is basically the physical tangible asset which you have. It is not very easily liquidable or sellable. There are a lot of costs which are related or associated with it. Also, the location where the real estate or your property is matters. A good rental value also matters. There are 4 major costs which is associated with a real estate investment that you should keep in mind as a prudent investor. Number 1, there are a lot of legal fees which are associated with buying and selling of property. The most common is the stamp duty and the registration fees which is there. There are also maintenance fees that you need to pay. That would be for maintaining the property. There would be taxes which you need to pay on a regular basis. There would be certain insurance costs that you need to pay for a property or a property investment. And there would be other miscellaneous expenses that you need to bear on a recurring basis, like repair and maintenance. These are some of the costs which is associated with investing in a real estate. There are 7 different or variant of investment that you could choose from. You can either buy a residential property or a commercial property. Residential property is for non-business use. Commercial property is basically for business use, that you can lend it to a company, or for office use you can lend it to anybody. There are also properties which can fetch you rental values, that is rent on a recurring basis. You may also buy land. You can construct the house and you can construct either residential or commercial property depending upon you. You can either create a recreational sort of property wherein people visit to have a fun time, or you can own a farmhouse which you can invest. Then there is something known as real estate investment trust. This is a very unique type of investment. Real estate investment trust, it is known as REIT, is a type of investment trust or an investment vehicle that you can invest into real estate or real estate related asset with an intention to earn income. It is more or less like a mutual fund. There are various advantages of investing into real estate trust. It is easily traded on stock exchange, from where you can buy and sell. An investor can expect a decent income of up to 90%. It also helps in your diversification of your portfolio. Now, there are certain disadvantages also of investing into real estate investment trust, that is REIT. There is limited growth opportunities. Dividends are always taxable and it is taxed in the hand of investor. Performance always depends on the real estate performance. There can be a variety of real estate investments, that is real estate investment trust. It could be equity related, or it could be mortgage, or it could be a combination of both. It could be a private real estate trust, or it could be a public non-listed real estate trust, and much more. There are 13 costly mistakes while investing into real estate you should avoid. Always do a background check and a background research, that is very important, which most of the investors don't do. Always conduct due diligence and find out what is right, what is wrong about that property. Always do a due diligence and market research. Always evaluate the market. Do not hire agents, a fictitious agent or a wrong agent. Always take help of a bona fide agents if you really want to buy a real estate. Please do not buy any property. I repeat, please do not buy any property or invest into real estate which is out of your budget. Suppose your budget is of $1 lakh, don't extend it to $2 lakh, or let's say $1,10,000. That is not worth buying it. Remember the rule that no one gets rich overnight. If you think that the famous investors have become rich overnight, then that is myth. They have become rich by staying invested for long term. I am not saying that stay invested for long term in this asset class, but always while investing into this type of asset class, you should be extremely diligent in your research and you should carefully select the property. Also, it is important that you should take into account all the expenses which are associated with the property. Most of the investors don't pay much attention to it. Please do not make this mistake. Please do not take exotic funding. There would be many agents or brokers who would like to fund you in a structured manner by creating an exotic product. Please don't get into it. It is not worth it. An exotic funding would be like, initially they will convince you that you have to pay a lower amount of monthly EMI, that is equated monthly installment, but over the period, that is over 10, 20 years, 30 years, your EMIs would rise suddenly. That is not worth it. Don't get into exotic funding. Do not, I repeat, do not rush for a deal and do not hurry for a deal. If you rush for a deal, you might make some mistake which would be very costly. Always read through the paperwork. Always read the fine print. Always read the agreement. Even if you are not a lawyer, you can understand basic terminologies. See and find out if there is any legal clause or legal hassle which is there. If you are finding it difficult to understand, take help of lawyer. They'll be in a better position to guide you. Do not trust, I repeat, do not trust anybody blindly with your money, especially when you are investing into real estate. It is not worth it. Always search multiple properties and do a thorough research before finalizing one. As a prudent investor, if you keep in mind all these 13 points, you would avoid costly mistakes and you would avoid regretting it later. Gold is gold, silver is gold. If you don't do apt diversification, you'll get clean gold. Investing into precious metal always acts as an hedge against an inflation. It always helps you to hedge against inflation. Inflation is the one who reduces the value of money. You remember? We covered this. Now you would ask, how do I invest into gold or precious metal? You can always invest via commodity exchange, like there are stock exchange for buying and selling shares and bonds. There are commodity exchange which buys and sells precious metal. There are also metal exchange traded funds like mutual funds. Those are traded on stock exchange that you can buy. You can also buy through a gold mutual funds or via some mutual funds which invest into precious metal. There is also something known as derivative market. This will cover while I cover the derivative market, that it is also a type of exchange wherein you could buy and sell derivatives from the stock exchange. Derivative is also type of an asset class, just to give you a simple understanding of it. You can also invest into stocks which are specifically related to mining of precious metal. Now you would ask, what are the plus points, or why should I invest into precious metal? As I told you, it acts as an hedge towards inflation. It is easily cashable, or it can be sold easily. It has a safe store value, means the value doesn't decreases over time. It also helps you in case of crisis like war-like situation or any serious crisis. You can always exchange it for essential items or any other important stuff which is required for you to sustain. There are also certain risks that shouldn't be ignored. That is, drop in value. The value can drop. Sometimes it is very difficult to find a buyer who would buy gold or silver or any other precious metal. It's better to have an exchange traded fund. There are at times shortage of supply, and most of the time there is always a price pressure which is there. You will see that the price keeps on fluctuating. Also there is currency risk. What do I mean by currency risk is that worldwide the currency rates keeps changing. So your country's currency rate would be different when it is compared to dollar, or dollar rate would be different when it compared to any other currency, for that matter Indian rupees. So there is always an inherent currency risk which is there. This should also be kept in mind while investing into gold, silver or any other precious metal. Fixed deposit is like your liquid cash. Fixed deposit is also known by various names. It is known as certificate of deposit. When you do a fixed deposit on a monthly basis, it is known as recurring deposit or an RD. Fixed deposit is secure. It is liquid. It is secure up to the amount which is guaranteed by the insurance company, that is Deposit Insurance Credit Guarantee Corporation, and that differs from country to country. In India it is guaranteed up to 5 lakh rupees per bank account. It always has a tax implication, so the interest is always taxable, excluding the non-taxable slab. There is also a risk of inflation. For example, a fixed deposit which is yielding or giving you an interest rate of say 10%, and say the inflation is about 6%, the net effective money which you get in hand virtually is 10 minus 6, that is 4% on this deposit. Also there is an important catch that you should catch here. There is always a premature penalty in case if you close the deposit before the maturity. It always charges you a premature penalty of 1%. Also the contract, since the contract is broken, the current rate is applied. For example, you have booked a fixed deposit at the rate of say 10%, but now the current rate is 8%, so you would be given your money back at the rate of 8% minus 1% premature penalty, that is 7%. Please keep this in mind. Every decade or so, dark clouds will fill the economic skies and will briefly rain gold. When the downpours of that sort occurs, it is imperative that we rush outdoor carrying water tubs and not teaspoon, and that is what we do in bond market. To understand bond, let us understand you take credit from the bank, correct? Like home loan, personal loan or education loan. Similarly, companies take or borrow from the public, that is they borrow from you, and they issue you a bond with an assurity that they'll pay you a regular interest, and they will also give you your money back on maturity. The advantage of holding bond is you get a steady income. It is less volatile, it is less risky depending upon the type of bond you invest into. A negative point of bond is that it is not tax efficient, and it could also be very costly in case if you invest into wrong sort of bonds. Also, it is important to know that you don't get voting rights in bonds, but you always get a preferential treatment when the bond matures. For example, say a company goes bankrupt, the first preference would be given to bondholder while liquidating the asset. Then the stockholders or the equity holders would be given preference. There are various types of bonds. Government bonds is also known as GSEC bond or gilt bond. GILT, gilt bond. It is the safest instrument and it is issued by the government of your specific country. Corporate bond on other hand is issued by corporates. While investing into corporate bonds, it is very important to look at the rating. Higher the rating, the safer the instrument. Lower the rating, it is less safer and it is riskier to invest. That's why it is mostly known as junk bond, because it will give you a very high yield or high interest rate on the investment, but it would be considered to be having a high default risk. Default risk is whatever money you have invested, just forget it. You may or you may not get back that money in case of junk bond. In case of corporate bond, higher the rating, safer the investment. In zero coupon bonds, we do pay any coupon, that is, they don't pay you any interest rate, but what they do is instead they will discount it at current price. For example, zero coupon bond, basically they discount the face value. Face value is the value which you get while buying a bond. For example, a face value of a bond is typically $1,000 or $10,000 in case of India. It varies from country to country. So this face value is discounted. For example, instead of 1,000 you would get it at 800 today. So is it worth to buy a zero coupon bond? That is something that you have to calculate considering the period you are invested into. For example, if you are getting $200 for staying invested for 10 years, I don't think it would be a prudent choice, because getting $200 on 1,000, to put it in simple terms, zero coupon bonds are sold at discount than the actual face value. Municipal bonds are basically issued by the municipal corporation, and it is also slightly, I cannot say riskier, but it is slightly riskier than government bonds. There are few things that you need to know. Face value is basically the price of bond when the bond is first issued, the value on its face when it is issued. That is known as face value. Coupon is basically the interest which you earn. Principal is the amount of investment that you are making. That is the original principal. Maturity value is the value that you get it on maturity. That is when the bond matures. It is 2020 and say the bond matures in 2030, and so the maturity time would be 10 years and the maturity value would be the value that you would get in 2030. Par value and the face value means one and the same. It is used interchangeably at most of the places, so it is one and the same thing for stocks as well as for bonds. Yield is basically the return that you get on maturity. Yield comprises of the coupon or the interest that you are earning. It also includes the various payment that you receive over the year in case of a regular interest paying or a coupon paying bond. Maturity date is the date when the bond matures. If the bond is priced higher than its face value, it is known to be at premium, If sold at a lower than its face value, it is termed to be. You should also remember that a bond is inversely related to the interest rate. As the bond prices increases, the interest rate falls, or when there is an interest rate rise, the bond prices fall. So they are both are inversely related. So in a declining interest rate scenario, bond becomes an attractive investment. In a rising interest rate scenario, the bond becomes less attractive. There are also certain risks which are associated with bond that one needs to keep in mind. There could be a downgrade in rating of a particular corporate bond. The inflation can erode the value of your investment. There is a high price fluctuation in bond market. The longer duration bond, that is, the longer you hold, there is high chances or high probability that the price would fluctuate, because interest rate is never constant. Interest rate keeps on changing. Therefore, it impacts the bond yield. It doesn't mean that if a company or a government has promised you to pay 10%, they will pay you 9%. No, it is not like that. It is just that the value of the bond which is traded on the stock exchange would reduce or would increase depending on the price fluctuation and the market situation. There is also a default risk which is very high in case of junk bond, wherein they offer you a very high or attractive interest rate or a coupon. There is also a big risk which is there, that some bond issuer may call back the bond before it gets maturity. Means they will tell you to return that bond, and they will return your money, and they will pay you till that date whatever is the interest or coupon accrued, and they'll close it. Generally, when would a corporate do like this? A corporate would do this when the interest rate is low, because they have to pay higher interest rate or higher coupon. As an investor, you can also sell before the maturity when the interest rate is high. This is costly and not very beneficial. Mostly this is prevalent in case of callable bonds. In the exercise section, you will find two bond prospectus. You need to compare two bonds and find out which bond is more riskier. You need to submit your answers in the question answer section of this course. This will help you to understand the risk associated with the bond and how you can assess the rating. Let exchange and trade funds. Now, what is exchange traded fund? These are funds which are traded on stock exchange. It has a lower cost. It also helps you to diversify because it gives you access to wide variety of options and wide variety of investment basket. Also, it is tax efficient because it is taxed only upon selling the investment, whereas in case of other funds or other asset class like mutual fund, where you incur the burden of tax over the course of the investment. It is very transparent. It is transparent because the holdings where they invest is disclosed to the public, and it is also published on a monthly basis, fortnightly basis, or on a quarterly basis depending upon the type of exchange traded fund, and it is quite tax efficient. There are certain risks associated with exchange traded funds. There are trading and other fees. The cost may not be just the expense ratio, it would also include certain commission and other miscellaneous fees that are related to this. The price change, which is very prevalent because the prices are dependent on the current market prices. In case of equities, the prices are dependent on current market prices in case of equity or bonds, but in case of exchange traded funds, they are not traded so much, hence there is a less price change, which is also a risk. It is not very easy to sell because the number of buyers in the market is less. So these are some of the risks that you should keep in mind. There are small saving schemes like Public Provident Fund in case of India. There are also postal deposits or deposit that is issued by postal authorities like Kisan Vikas Patra, national saving schemes, or there are also certain senior citizen or elderly saving schemes which offers a higher interest rate compared to other instrument or other asset class, and it is quite secure because it is issued either by a reputed government agency or government appointed agencies like postal authorities. It has no risk or lowest rate of risk when it comes to investing in small savings schemes. The risk would be in terms of interest rate fluctuation. Government may change the interest rate. The plus point here is like SIP, you just need to contribute a smaller amount, and there is no commitment of investing larger amount in small savings schemes. You can diversify your portfolio. Cryptocurrency is not legal in most of the countries, hence be very mindful about investing in cryptocurrency. Cryptocurrency is an alternate form of investment, but this is a most riskiest sort of investment. It's similar to that of a derivative investment, but here the risk is much higher, and in case of derivative also the risk is much higher. So please be very mindful while investing into cryptocurrency. Now what is cryptocurrency? Cryptocurrency is basically a digital or an electronic form of currency. It is not controlled by any one single person or an entity. It is decentralized in nature, means no one actually controls cryptocurrency. It can be spent virtually anywhere. The best part is that it doesn't have any chargeback. A credit card company can always charge back. Let me explain you chargeback. In case of credit card, a credit card company can always charge you back before the settlement date. But in case of cryptocurrency, there is no chargeback. A cryptocurrency can be issued in form of digital currency, or it could also be issued in form of tokens or utility tokens. Ethereum is the best example of it. Why it can be issued in form of utility token, and what is the use of having it as a payment token like a digital currency? Also, it has some functional use beyond money. For example, a company can give access to its product and services in form of some utility which a person enjoys. That is utility token. Most of the ICOs, that is initial coin offering, fall under this category. Why do people invest into this? Because with the hope or expectation that as this company would grow, the value of utility token that I hold might increase in its value in future as the company grows. You do a proper due diligence before investing into ICOs, because there are a lot of fraudulent ICOs, that is initial coin offering, which is there in the market. It just requires some programming to create a cryptocurrency. Hence invest into a reputed cryptocurrency only. Also, before we understand how to invest in cryptocurrency, there is a type of cryptocurrency or crypto asset that you should remember. That is security tokens. What is security tokens? Security tokens, basically it gives you an assurity of ownership. It gives you some ownership right of that company. For example, say Prakash plans to issue a crypto asset. So what Prakash would do is, it would give you ownership that is 10% or maybe 5% or 15% depending upon the size of your investment. Ownership right, that would be the security token. That would be Prakash security token. Now that we know basically what a cryptocurrency is, and just to give you a short example, a cryptocurrency can be spent virtually anywhere to buy goods, services, product, etc. The most famous example of cryptocurrency is Bitcoin, Ethereum. These are some of the most famous cryptocurrencies which are there. The most famous example of cryptocurrency is Bitcoin. Now, how do we invest into cryptocurrency? In order to do a cryptocurrency investment, you need to get a wallet. Wallet is basically like a bank account wherein you need to create the wallet. You need to create an address. Address is basically like a bank account number. This can change. You can have multiple bank account numbers in case of cryptocurrency. Once you create a cryptocurrency account and once you have created an address, you can buy and sell cryptocurrency only from a reputed exchange like Coinbase. I repeat, Coinbase. And also remember rule of 1%. Do not invest more than 1% of your total net worth in cryptocurrency. I repeat, do not invest more than 1% of your total net worth in cryptocurrency, so that in case if you use your money, you do not lose more than 1% of your investment. And if you gain, you can gain much higher than that, but do not invest more than 1% in cryptocurrency. You can create a cryptocurrency portfolio. There are certain important points that needs to be remembered. Start with a very basic small amount. Try and see how it works. In order to make payment or do some transaction, you need a password. This password is known as private key. Please do not share this private key with anyone. If your private key is compromised, your cryptocurrency or your crypto asset is lost. Always keep a tab on the rate. There are very wild fluctuation in cryptocurrency. One day you will see the Bitcoin rate is trading at $7,000 per Bitcoin. Another day you will see the price has gone down to $2,000 per Bitcoin. So there is a very wild fluctuation which is there. Always keep transacting so that your wallet is active, and always use a new address every time. Do not use the same account every time. You can use the same wallet every time to store the cryptocurrency, but do not use the same address. It becomes very easy for the hackers to track you or to defraud you. Always keep your password, that is your private key, your PIN, your wallet PIN and your password safe and secure. Never for God's sake connect to a public Wi-Fi, even if it is free or it has a fantabulous speed. Do not connect. Once you connect, be rest assured your sensitive information is leaked. Also, always use a trusted own mobile phone or laptop to generate private key, that is your password. Please do not gamble. No one becomes rich overnight. I repeat, no one becomes rich overnight. Do not use the same wallet address as I mentioned earlier. Never leave your money at the exchange, because some exchange might get bankrupt. So never leave your money at the exchange, and do not put all eggs in one basket. What I mean by that is diversify your portfolio. And also please remember that in cryptocurrency no one can give you 500% return in a week. Most of the tips which you would get is a scam. Be aware of it, otherwise you will lose your hard-earned money. Derivative is basically a contract between two or more party. What is a contract? Contract is a mutual agreement between two people or two or more people that you will comply and abide by the rules or the stipulated agreement between us. Let me give you an example for you to understand it better. So say I am a pet shop owner and I sell exotic pets. Now, due to outbreak of some serious infection, I might be thinking that my exotic pets might get infected. So what I would do, this I don't know today, but I have that risk in mind that it might be possible that my pet would get infected. So what I will do, I will ask the other party who is willing to take that risk, that say after 6 months I will sell this exotic pet in the pair of 10 to you at a particular price. Let's say for now let's keep a value of $10,000. So my cost today per exotic pair of pets is say $500. So I'm already at profit, selling him at $10,000 after 6 months. So this is the contract which we have entered into. This is basically known as derivative. The derivative value is derived from the underlying asset. In this case, the exotic pet is the asset and the value is derived from it. It is the most riskiest instrument. Some of them has also termed it as financial weapon of mass destruction in case of personal finance. It is the best alternative investment option as well. It is the most riskiest investment. So aggressive and super aggressive profile can invest or take exposure into derivative. Let me give you another example. A derivative could be like a convertible bond. Now at the discretion of the bondholder, it may be converted into fixed number of shares or stocks at a particular future date. The value of convertible bond depends upon the value of underlying stock. Thus, it is a derivative instrument or a derivative asset class. Now, few of the icebreakers or few concepts that you should remember is something known as margin. Margin is basically the small portion of payment that I make to take a large exposure. Let me explain. Suppose I want to buy $50,000 worth of Amazon. So what I would do, I would pay 10% as a margin, that would be $5,000, and buy a derivative contract. This I will buy it from an over-the-counter market. Over-the-counter market is like a stock exchange only, where the derivatives are traded. Most of the derivatives are also traded on the stock exchange. Strike price is basically the price which is fixed in one type of derivative which is known as option contract. Let's say an investor or a buyer purchases a call option of a XYZ company's share at a strike price of $500 per share. So that is a strike price. That is the price that is fixed in a derivative contract. Contract is basically an agreement that we just saw. Forward contract is something that in future date I will agree to sell something at a present agreed value at a future date. Let me explain. In case of the exotic pet example, I am the pet owner. I am the owner of the pet shop. I entered into a contract. I entered into a forward contract that say after 6 months the person will buy 10 exotic pairs of pets at the price of $10,000. That is, we both agreed into or entered into a forward contract. Forward means we have entered into a contract at today's date and we have decided the value at today's date, that after 6 months this is the value that I am going to receive and this is the product or goods that a person would receive. A forward contract can or cannot be through a stock exchange. It is more like an over the counter, that is an agreement which we just saw an example of an exotic pet. In case of future contract, this contract are standardized by the stock exchange and it cannot be modified. The buyer and seller has no right to enter into contract directly in case of future contract, and they have to take help of stock exchange only. A future contract is settled on a daily basis, so there could be either an extreme profit or an extreme loss. In case of option type of derivative or option contract, option buyer has no obligation. There is no margin that is required to be paid, but here the premium is required to be paid. Also in option contract, there is no settlement which happens if the buyer does not exercise the option. If a buyer exercises the option, then the settlement needs to take place. Now let us understand what is call and put option in option contract. A call is an option contract that gives the buyer the right to buy the underlying asset at the strike price at the time of or at the expiry date. Let me give you an example. A stock which has a call option with a strike price of say 100, it means that the buyer can exercise his power or right to buy before the option expires at the strike price of $100. It means the buyer can call the stock before the option expires. In case of put option, what happens is, here it can exercise the right to buy, but in case of put option, the buyer exercise the option to sell. Let me repeat, in case of call option, the buyer exercises the right to buy before the option contract expires. In case of put option in option contract, the buyer can exercise the sell right to sell the stock before the option expires. Let me give you another example. When would a buyer exercise a call or a put option? A buyer would exercise a call option when the stock price is very favorable, and a buyer would exercise a put option when the price is at a premium. For example, if a buyer has bought a stock at a price of say $80 per share, and if the price is quoted $100 per share, the buyer can exercise the put option before the option expires. So remember that in case of option, the buyer enjoys the right but not the obligation to buy and sell an underlying asset. Also, the downside is limited to the extent of premium which is paid. The losses can be unlimited, whereas the profit could be limited. So future contract, both there is an potential unlimited losses as well as potential unlimited profit. A swap is a contract between two parties where one party agrees to exchange a stream of payment with another party for a specified term of maturity. For example, a large bank can borrow a loan at a fixed rate and it can swipe it for a floating rate to take the benefit of the interest rate. This is known as interest rate swap. An investor always looks for safety. A speculator always looks for quick profit. It is up to you to decide which category you fall into. As the name suggests, private equity invest into private company. What they do by investing into private company? They take the ownership of the company, and not 100% ownership, but they try to bring in a good management into the company's board and change certain operational deficiencies. Let me give you an example. A company which is not performing so great but it has high growth potential, a venture capitalist or the private equity firm would find out this sort of companies, and they would do certain restructuring by getting some brilliant mind on the board, changing the way it operates, improve its profitability, and the main aim is to sell it after a particular time period. What do they get by investing into these private companies? They get a percentage of the profit which the company makes, also a series of payment when a company makes a profit, and also part of the sale which the company makes while the company is sold. In case of startup, it is just starting up, so there are a lot of good startups. The famous example would be Uber. Uber does virtually own any car, but it is the best car rental company in the world. There are various types of private equity. One is known as venture capitalist. They get small seed funding for the startups who have high growth potential. Then there is second type of private equity, which is known as growth capital. They invest and find out large public company. Those are listed cheap, and they get lot of debt funding into these companies via bond or via some type of structured loan, ramp up the company's growth and sell off that company after a couple of years. That is the growth capital that they invest into. This is also a type of private equity. Another third variant which is very common is known as leverage buyouts. It is also known as mezzanine capital, which pumps in lot of money into a company, improves its efficiency by cutting cost or doing lot of internal restructuring. In fact, in most of the cases they lay off most of the employees also, and they sell it off when the market is good and when the company's price is best, and they book their profit. Leveraged buyout, LBO has been criticized because they adopt an extreme form of cost cutting. They reduces the loan payment, they reduce the debt. They also improve the company's short-term performance by cutting costs, giving pink slip to the employees, even selling off some of the essential assets so that it looks like it is a boost to a company's profit, and they sell it when they get a decent price. That is leveraged buyouts. Now, as an investor, you would ask, why should I invest into private equity? Private equity is risky, but at the same time it can give you a return which could be an upward of 18 to 20%. That is not assured or guaranteed or written anywhere, but a good private equity firm like a Blackstone, TPG, KKR or Carlin Group can get you a decent return. These are most reputed private equity firm. Then you would ask, how do I invest into private equity? The investment in private equity can be made through a private equity trust, or it can also be made via fund of fund, like a mutual fund which invests into fund of fund, and it can be bought through exchange via exchange traded funds which invest specifically into private equity. It is very risky mode of investment, like a derivative instrument, because there are many shell companies, means companies that do not have any physical presence or any operations. They have just virtual presence and they show that they are involved into some sort of manufacturing and stuff, but they are actually not there. They are basically there to shell off your money, that is to defraud you. So be aware of these shell companies. There is also something known as SPAC, Special Purpose Acquisition Company. They specifically invest into undervalued companies or traded shell corporation. Be aware of this SPAC, otherwise it will give you a tight pack on your head. Excuse me for that, but it could give you a very strong downward push. That's why please avoid investing into shell companies, special purpose acquisition companies. If you want to invest in private equities, try investing through an exchange traded funds which invest into private equity. Insurance is basically an assurance that your risk would be transferred or your risk would be covered in case of some unforeseen or unexpected event occurs. So there are two broad categories of insurance. One is life insurance, which secures your life or insures your life. There would be some plans which would give you some return, and there would be some plan which would be completely covering the risk. The other form of insurance is general insurance, which covers general or non-life things like insuring your home, insuring from fire, any natural calamities, hazard, health insurance, disability, accident, and so on. The list goes on. In case of life insurance, you should always remember that term plan is the cheapest and it is the best to cover the risk. Term plan covers your lifespan. All you need to do is make a recurring payment for an expected years, and it covers you for n number of years. Say I live till the age of 80, so I will take a term plan till the age of 80. Suppose something happens to me, my nominee would get, the nominee is the person whom I assign, that in case if I am no longer there, somebody else would get that money. So that is known as nominee. So the nominee would get that lump sum amount, which is known as sum assured, in case something happens to me, in case of term plan. In case of annuity plans, you will have to invest a particular amount, and after waiting for a couple of years, you will start getting a series of payment as in pension or as an annuity, or you can put it in simple terms, you will get a recurring payment in your bank account. Those are annuity plans. Then there is something known as unit link insurance plan. Unit link insurance plan is more or less like a mutual fund, but here there is an insurance which is linked with the investment. I would again reiterate, never mix insurance with investment. Undoubtedly, unit link insurance or insurance linked plans are good over long term, but I would suggest as a prudent financial planner never to invest into an insurance linked plan, because it has its merit and it has its demerits. You should always keep an insurance separate and investment separate. Then let us look at general insurance. Why general insurance is important? In case something happens, say somebody comes and steals your valuables, you would be left with nothing, right? Or say there is an earthquake and the building collapses. So you should have an assurity that your home is secure from man-made hazard. It should be secured by problems created by human being or problems created by nature, like earthquake, thunderstorm, flood, etc. Then health insurance purely covers your health. You need to take care of your health, because the medical expenses worldwide is very large. You need to take a health plan which gives you a proper cover, and it also gives you an assurity that in case you met an accident, your hospitalization costs should get covered, your medicine part is taken care. All these things needs to be taken into account. Always, while buying any type of insurance, the thumb rule is always read the terms and condition and always compare the products with various other plans. It is very important. Then there is also known as disability or accident insurance. Accidental insurance pays you in case if you met in accident up to the sum assured. Disability in case if you lost your, God forbid, if you lose your hand, leg or any other vital part of your body, and that is termed as disability, the insurance covers that disability part. These are some important things that you should have in your kitty while you are making investment or doing an investment portfolio allocation. How insurance act as an antivirus? Now let me tell you, it is PIS. That is, it helps you to preserve your risk, it insulate you against the risk, it shield you against the risk, and it also secures your risk. That's why it acts as an antivirus. Always buy an insurance cover for yourself, and always have an health and general insurance for various property or mortgage which you are taking. Suppose something goes wrong, you always have a backup to cover it up. It shouldn't be a burden on your family members in case if you are no longer there. So always take an insurance.